what if most of the things that you learned about property investing were not accurate and also stifled your growth and your property portfolio? Hi, I'm Jaryd Krause. I'm co-host of Property Pals Australia.
And I'm Sam Powell. And in this episode, we get to talk to Goose McGrath, who's the co-founder of Dashdot Buyers Agency. And he's been around since 2019 and learned a lot of lessons along the way. And we have a really good chat about, going from what he thought to what he now knows, and also really key insights, wasn't it, Jaryd, with like the level of location research and data he goes into, and even the importance of starting with strategy.
Yeah, we busted a lot of myths around locations, around like infrastructure, changing growth in locations, interest rates, when interest rates affect property prices, when they don't affect property prices, what to look out for in the future of interest rates. We talk about the debasement of money, why if you want to get ahead, you must be investing. Not just in property, but setting yourself up for your financial future. And then, we move into strategy and we share some examples of like different like ways to go about investing in property based on where you're at, your risk tolerance. We talk about your hurdle rate. There's so much in this pod. You guys are going to absolutely love it. So dig in. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Goose, welcome to the pod.
Thanks, man. Nice to see you again.
Yeah, long time coming. Bought my first property with you guys. Frothing, you've just inspired this pod for sure. Or
Awesome.
At least my journey anyway. So thanks for your time. Thanks for coming on.
Absolute pleasure, man. Absolute pleasure.
Yeah, Australind has done really well over the last couple of years, mate. So your data and research is obviously on point.
Yeah. It's funny. Another little suburb over there that we got into early was Armidale in WA, and it's so funny because we were getting in there and everyone was just so fundamentally opposed to it. Just like it was like I was, we couldn't even talk about it around a dinner table, sort of like in closed circles, because people were like, "Oh no, that's mad." It ended up being one of the best performing suburbs in the last year. I think it was one of the top 5 best performing suburbs. So yeah, I mean, it pays to get in early with high conviction and make a really good go of it. That's the secret.
That's a really good point. It feels that is it's like a theme, right? You introduce a new location and people are like, I wouldn't buy there because I wouldn't live there. And then they turn out to be the best performing ones that, like Armidale. I'm even going into Townsville back in the day and everyone's like, oh no, I wouldn't do that. And now everyone's flooding in there.
Wow. Everywhere, every single location that we've ever gotten into, I mean that literally without exception. Every single location we've ever gotten into, we've gotten in there at a point where people are saying, "Why would you buy there? That's a mistake." And that's kind of it's. So we can kind of like talk about why that's good and why that's important. It's also not the be all and end all, by the way. I'll also talk about that because you can also get into markets that are already growing. That's also not a problem. The issue comes because most investors. They listen to all the barbecue chat. So they might say, for example, go back a few years, Townsville is now known, right? But once upon a time, it's the arse end of nowhere. It's not going to go well, and it's performed terribly over the last few years. And so people listen to coffee table chatter or barbecue chat, and then they get scared and they don't want to invest, and so they end up investing where things have already grown, and that becomes that can be problematic. It's not always problematic, but it can be problematic. And so, like part of the trick is being able to see things that other people can't see. And I think that permeates not just in real estate investing, but that permeates across all types of investing. It's like how can you How can you see the things that other people can't see? If you look at companies like Tesla, for example, great example of where retail investors were able to outrun Wall Street investors because Wall Street investors couldn't see the big picture, and then Tesla grew by a ton, and it's probably going to grow a ton again right now. There's other companies like that as well, and the question is, how do you become an informed investor? So there's this idea called the impound rate of knowledge, and basically what that essentially means is all markets are efficient to the degree that they are informed, to the degree that they have information. Now, things like stock markets and stuff, they tend to have a lot of information, and so they tend to be more efficient because it's easier to get access to all the information. Because all the, there's quarterly filings and all of this kind of stuff. You can see all the revenues, you can all of these kind of things. But if you were to imagine a theoretical event, right, where let's say the CEO of Apple was flying across the Pacific and the plane crashed. Now, at the moment that the plane crashed, if no one knew the plane crashed, nothing would happen to Apple's share price, right? Because no information had transferred to the market. But then as soon as one person heard about that one person would have an information advantage, and they would be able to, if they owned a bunch of Apple shares, go and sell those shares before the rest of the market knew, because they would have an information asymmetry. They'd be able to see something that other people can't see. Therefore, they'd be able to make a more informed investing decision. And now that's obviously a very simple, and then obviously as that information then spreads and suddenly it goes on the news and everything like that, and then Apple share price would go down. Now that's just one example to kind of illustrate the point around getting an information advantage, but that's really the key. And people think about risk as well, and people hear, getting into a location like Townsville a few years ago. Again, Townsville now is not a new story, so I'm happy to talk about that and use it as an example because that's years old. That's a years old story now. But at the time, it's this fear. It's like, it's risky and all of this kind of stuff, and what if. And risk is actually a function of how much information you have to be able to make an informed and intelligent investing decision. So the degree to which you can find signal and not noise, and to the degree to which you can identify things earlier, or to the degree that you can identify where things are going when other people can't quite see the same trajectory, i.e. signal versus noise, that's the degree to which you can make good investing decisions.
Yeah, absolutely. It's like cancer's very risky if you don't know you have it and you don't know anything about it. But when you go away and get diagnosed, you're conscious of it and you can do something about it.
100%. Yeah, 100%. Yeah, I get blood tests. I get blood tests regularly, not because there's anything wrong, but because I like to stay on top of my health and I'd like to know in advance if there is something wrong or if there's something I can tweak. Classic example is people get to 60 years old and turns out they've got blocked arteries and their blood pressure's too high and that risk of heart disease and stuff like that. Actually, if they were 40 and 30 and they started getting blood tests, they could have managed their cholesterol a little bit better. And it's like, how do you start to make these decisions earlier? Now, the point that I'll just quickly make though on this is we can start to develop a preconceived, when we talk about early, we start to develop these preconceived ideas that the only way to find investing success is to find some barren market where no one has been before. And that can lead to two systemic biases. One, it can lead to a bias where you can look at a location and on the basis that it hasn't performed in a long period of time, you can say, well, that must mean that it's going to go up, which is not true. So you can start to have an uninformed bias on that side. But then you can also have a systemic bias in another way where you can look at a location which has already gone up by a decent amount and define decent, 20% in 2 years, 30% in 2 years, whatever the number is, right? And you can say, no, we're too late. We shouldn't invest there anymore. And, that in and of itself can also be a big mistake too, because, if you look at Warren Buffett, one of Warren Buffett's best investments was in Apple. And he's sold a fair bit of it recently, but one of his best performing investments was in Apple. And he didn't start investing in Apple until 2016. Now, Apple, I think, went public in 1987. Don't quote me on that. But they'd been public for a very long time. They weren't a new news story. The iPhone was released in 2007, right? So it's not like he got in it. It's not like he saw some big. No, it had already been growing by thousands and thousands of percent. And then he was like, okay, hang on a second. I think this is going to keep growing. So he invested and ended up becoming. And he was 35 years late to the party or whatever the number is, right? And he still made. It was one of his best performing investments of all time. And so the trick is really trying to weed out the signal from the noise and to understand what those opportunities look like. Now, getting in early is good, but staying in for the right amount of time is also good. Or knowing that you can still get into a market that is growing and knowing that it's got a fair bit in front of you is also really good. So, yeah,
such good insights, and yeah, the rate of information is so key. also for, like you mentioned, how long to stay in the market. And we've talked about like trading properties now more than just like holding for decades and decades and decades and buy a property and hold it forever. What have you seen and how have you worked with people? And do you have like because it's very subjective based on the area and the time that we're going through in the world for those markets. But are you seeing more people buying, holding for 5 years, 8 years, selling, or maybe 3 years, even 4 years?
Yeah.
What's that look like for you guys?
So there's a couple of factors in that, and it's a really good question to ask. And the old way of thinking was buy and hold forever, and that's true. By the way, it works, but this comes down to a function of information advantage. And if you sort of zoom out a little bit, why would that still be true? Why would buying and holding forever still be true? It's because we have a structural secular trend which is going to drive property prices up continuously for a very long time, and that's effectively monetary debasement, right? That's effectively the main driver. So because M3 money supply has increased by 11% a year since 1965, right? That is actually the thing that is causing asset price inflation. So that thing specifically. So if you take that on face value, that means very broadly, the real estate market is going to continue to go up. Now, the question is, within the real estate market, what markets are going to perform differently in what ways and why? And so then you get down to a point where it's like, well, the thing that is the kind of three core drivers of any location are lifestyle, jobs, and relative local affordability, right? So relative local affordability is we just say lifestyle, jobs, and affordability, but specifically it's relative local affordability. And that's really interesting because what that does is that dictates the ebbs and the flows of where money flows through the market, whilst in aggregate, the property market continues to grow overall. So, you can imagine a scenario where, like if we take Melbourne right now, for example, Melbourne is in a bit of a slump. So in principle, its relative local affordability is getting better. Now, that's been corroded away by consumer price inflation and stagnant wage growth and a few other things. But that's what's driving people to other places around, like satellite cities like Ballarat, Bendigo, places like that. So that indicates the flow of the capital markets because people go to where they can more easily afford. Now, as the money flows from one market to another, that creates a deficit, and that allows money to flow back over time as wages increase. And so you have this kind of movement of capital through the markets. Cycle. And so, it's cycles, but it's like cross-border capital flows is kind of the easiest way or a different way to kind of think about it. It does cause cycles, but the cycles themselves are like I think you can paint things with a very broad brush, and you can say, the property market moves in cycles. Kinda. Some markets move in cycles for some ways. So, for example, like Rockhampton is specifically sensitive to Australian dollar versus US dollar exchange rate. Why? Because they're the beef exporting capital of Australia. So, if the Australian dollar strengthens versus the US dollar, then Rockhampton's market suffers more than other places, right? So you have these different trends that affect places in different ways. But what you tend to see is capital flows in and out of different locations in different ways at different times for different reasons. And if nothing changes about location, then it'll be for the same reasons, but it will be kind of cyclical, right? So if everything broadly stays the same. So, to that degree, if you were to, let's just say, keep it simple, let's say if you were to buy in Sydney and never sell, would that over a 30-year time horizon be a good idea? Like almost certainly. Why? Because of monetary debasement. Primarily. Primarily. Yeah. If you were to ask yourself, though, over any given point in time, if I had the opportunity to exit once I'd achieved a certain rate of return or a certain amount of growth, reposition my capital where money is going and accelerate my capital in that fashion, and then continue to rotate my capital through different markets, then would that be a better financial decision? Almost certainly, as long as you get it right. Because if you rotate capital into the wrong markets, then of course you're not going to get the returns. But that's the kind of risk. So the question then is, to what degree do you want to play that? To what degree do you want to play that game? And how do you want to think about it? Now, if it's just a case of how quickly can you get returns, then almost certainly it is going to be a good idea to consider selling some, if not all, of your properties at different points in time to rotate capital into different markets. Because the easiest way to make money is to work out where demand is going, stand in front of it, and open your wallet. And so if you know that demand is going to move from Sydney to, I don't know, Canberra, right? Just making stuff up here, by the way.
Yeah.
Then okay, rotate your capital from Sydney to Canberra, stand in front of the demand, open your wallet, and make the gains, and then move on. That's the investor mindset.
Yeah, so we've talked about that, and we totally agree with that. It just makes sense. It's basically assessing your opportunity risk within your portfolio multiple times, and it could be every quarter, 6 months, or a year. And so within Australia and working with your clients, have you noticed when is roughly after depends on when you get in the market, but is there a time frame, like a typical average time frame that people are holding property before they're relocating due to opportunity cost?
Look, it depends a lot. It depends on a lot of things, right? It depends
so
on
many variations.
Yeah. The short end would be like, I don't know, 12 to 18 months. Like that would be the very short end, right? If you got into a market a little late and then you were in it and you're like, okay, I've made some gains and I'm not confident that this market's going to continue to go up, that would be the short end. Would be, and that's obviously suboptimal. Like that wouldn't be
very suboptimal.
Yeah, I mean,
it
depends on the
considering entry costs, exit and entry costs.
Yeah. But let's say that you spent 20% of the capital on entry costs. Let's assume a 10% deposit and 10% costs, right? Just for simplicity's sake.
Yeah.
Let's say you bought a $500,000 property and your all-in cash costs for acquisition costs were $100,000, and let's say that $500,000 property went up by 15%. So we're looking at $75,000 gain. So then that would be a gain on top of your initial capital. So that's already factored in. So you can still make returns, and they can still be pretty good returns. And the way that I think about returns, because everyone gets a little bit everyone hunts the highest number, which ostensibly sounds like it makes sense, right? Like I want to get the most possible return for my money. I actually think the better way to think about it is what's your hurdle rate. I think if you understand what your hurdle rate is, then you can get really comfortable with making better investment decisions about when to exit, and you don't feel the need to FOMO stay in a market or FOMO into a market later. So just back to answer your question, typically you would be looking at something like a 5-year time horizon, but that could be anywhere from 3 to 7 years to rotate between markets, and it really does depend on when did you enter, what does the market opportunity look like. What are the kind of structural driving forces? Where do we think that market's going to go? Is it part of a significant, like a longer trend? Because sometimes markets can go up for 10 years, and sometimes markets can go up for 3 years. And so it's really about understanding that and making decisions with that in mind. But yeah, I would say the kind of ballpark average would be something like 5 years.
Yeah. And when you say hurdle rate, do you mean what, like your risk tolerance is? Is that what you mean?
No. So what I mean by hurdle rate is, so let's take a little step back. Like, why does anyone invest? Why does anyone invest?
Yeah, to grow their portfolio, to earn money, so they can have a better lifestyle.
Yeah, well, let's take that on a slightly different tangent. They invest because they have to, because their money doesn't hold value.
Yes, based on inflation. Yeah.
Yeah, based on inflation, right? So we exist in an environment where we get paid in a product that doesn't hold value.
Yeah.
It's debasing, right? And so if we don't want to die poor, so like you can save money and stick it on your mattress and it's going to end up being worth less in the future. So we all either explicitly or implicitly know that. Some people don't actually know that is the thing. They just need to know that they know that they need to like try and get ahead. And so because we have a broken monetary base, that means we have to seek risk. So seeking risk is really about trying to work out what is a better monetary alternative than the kind of fiat currency that I've been paid in or that I've received or that's sitting in the bank or whatever, right? So that's the kind of basis. It's the how do I make sure I'm not losing money? So then you got to ask yourself, like, what's the hurdle rate to preserve capital? Then what's the hurdle rate for you to increase your wealth? And they're two different things. And so if you just set your hurdle rate at how do I preserve my capital, then your hurdle rate would probably be something like 10 to 15% once you factor in all of the extraneous forces that corrode capital preservation over time. If your hurdle rate was how do I grow my wealth, then you would need to seek something like a 20% return per annum. So very quickly, when you start to look at that, you look at your investment options and you go, okay, well, where can I get a 20% return per annum on my capital on an ongoing basis? Like, what strategies are available to me to do that? Certainly investing in the ASX 200 or the S&P 500 or something like that, that's not going to do it, because, that's growing at like 7 or 8% a year, and that's just not going to cut it. Now, on face value, real estate grows at like 7 or 8% a year or whatever, and that doesn't cut it either. But the point, the point is that you can leverage it. The point is you can financially engineer the returns, and that is actually where the gold exists in real estate. Just an interesting kind of side note is, if the monetary supply is increasing by, it's increasing by like 11% a year, but let's call it 10% just for simplicity sake, and real estate grows by 7% a year, what does that mean? It means that relative to the money supply, real estate is actually losing value, right? Which is crazy, right? But the fact that it does operate in a consistent fashion, the fact that it is relatively stable, the fact that it is relatively safe as houses, gives us the ability to financially engineer that. Now, the degree to which you're able to, ready, willing, and able to financially engineer and pursue that path is the degree to which you're able to get returns that will be your personal hurdle rate. My personal hurdle rate is 20%. Now, that doesn't mean I get 20% returns a year. Like, my personal returns are something like, 100 plus a year. So I'm comfortable with that. But if you get too fixated on just how do I get the highest returns, then what you can end up doing is you can end up chasing yourself off a cliff. You can end up staying in situations too long, rather than just going, you know what? I had an investment recently, and it had gone up by 300% versus my initial capital, and I was like, man, that's 300%. And do I think it's going to go higher? Probably. But like, am I going to cry if I collect 300% on my on my investment? No, that's good. My hurdle rate's 20%. So why don't I just take some profit off that and move on and reposition the capital, right? And so thinking about that, I think, is really important, so that you don't get fixated on the wrong metrics.
Yeah, and also increasing your hurdle rate. It's just like anything in life. Like, if you set the bar too high, you stress out, you freak out, and when you stress out and freak out, you don't make the best decisions, and you put yourself in tricky situations. And that's anything in life. So setting yourself up to win versus setting yourself up to fail, right?
Yeah.
Now, I don't know whether this was counterintuitive to you when you first started, investing in property and learning about property, with the, how long do I hold a property for? Maybe it could be 3 to 7 years. What are some of the other if that was surprising, what are some of the other most surprising, like, counterintuitive lessons that you've learned about investing in property, and how has it shaped or changed a little bit?
Oh, there's tons of them, but I'll tell you one that's really interesting. Everyone thinks the infrastructure project. So there's two things. I think less so now, but like, the prevailing belief for a long period of time is that interest rates drive property prices, and they don't. And we could talk about that. But like, the correlation is like so minuscule that it's statistically insignificant. So that's wow. Fascinating.
That is fascinating.
It's really interesting, because it's completely contrary to what the common narrative is. The other one that was really interesting, and we discovered this by accident, because we wanted to produce. So we've got our data scientists, and we've got all these technologists, and we've got a whole team, and we invest a lot of money in science and stuff each year. And we thought, you know what we're going to do? We're going to start producing white papers, and we're going to start publishing these white papers, because they're going to make us look smart. Everyone's going to think we're awesome, right? So we thought, great, okay, let's pick a low hanging fruit. Let's pick something that's going to be an easy hit, just to get something out. And so, of course, infrastructure projects drive property prices, right? So we thought what we'd do is we'd do a study that shows the relationship between infrastructure projects and real estate prices, and expecting that we were just going to kind of like confirm the bias that everyone has, but kind of put some numbers around it and make ourselves look smart, right? We thought it was going to be easy. The problem is, it's not true. Like, and this was completely like, we had, look, it's crazy to think, right? Because we have this idea that like, a new train station or a shopping center or a new road or a highway or whatever the multi-million-dollar or multi-hundred-million-dollar project is somehow going to have a direct impact on property prices, just by virtue of like money flowing into the area or some kind of thing like that. And what we found is that it's just not scientifically true. It's true sometimes. So we found more cases where a new hospital didn't impact property prices than where they did. which is crazy. You would think a new hospital in an area would cause property prices to go up. But that's only sometimes true. We found, and so we had to dig deeper, and we had to really kind of uncover why is this, right? So hospital is just one example, but schools, roads, civil engineering. We looked at all of the different project types, entertainment precincts, etc. And what we had to do is we had to then divide. We had to build our own way to divide the country up into geographical areas based on socioeconomic and industry type. So if we found there was an area that had a certain socioeconomic profile and the main industry in the area was agriculture, then it would say, don't quote me on this because I don't know if this is, I can't remember the exact research in the report, but just as an example, if it was, we might find that location benefited if a new school was put in, but not if a new hospital was put in, or maybe the other way around. We found that in white collar areas, a hospital probably doesn't make any difference, but an entertainment precinct does, right? And so what we found was that some infrastructure projects impact property prices sometimes, depending on the relationship between the type of infrastructure project and the prevailing industries of employment in that area and the socioeconomic profile in that area. And so that was interesting because we just have this belief that infrastructure projects equal property growth, right?
Well, that's the narrative that we're getting. We've been fed for decades.
Yeah, exactly. So I always find that one interesting because it caused us to go down a very deep, rabbit hole and really start to pick apart what are the layers beneath the property market? Like specifically, why is Bondi different to Bundaberg? Specifically, why? And so we ended up with an index of 7 to 10 different location profile factors ranging from what percentage of industries were affecting those locations. So, for example, Bundaberg's obviously got more agricultural influence than, say, Bondi. Bondi's got more financial sector influence than Bundaberg, etc. So we're able to then start to weave through these kind of things and then profile locations in different ways. So, yeah.
It's really sounds like it's really based on the economy of that particular location and what it needs versus what we're told all of those areas need for growth.
Yeah. Exactly. And it's still, you go.
I was just gonna jump in and ask what was the other counterintuitive one that you had? You said you had two main ones there.
Yeah, interest rates. Interest rates don't drive property prices. So everyone thinks they do. And so when obviously we had a period where interest rates went very low and property prices were going up, and everyone's like, oh yeah, property prices are going up because interest rates are low. And that's partially true.
Very timely as this gets published, interest rates, the talk of interest rates getting, lower and lower and lower. Most people thinking, okay, let's go. But it could be a different story based on the areas as well.
Yeah. So lowering interest rates can have a positive effect on property prices. Raising interest rates, there's not a strong correlation between raising interest rates and lowering property prices. So people think it's a seesaw. Interest rates go up, property prices go down. Interest rates go down, property prices go up. They think it's this seesaw effect, and it's just not true. And so when we started going through an interest rate cycle change, we started going into a rising interest rate period. I started by doing the analysis myself, and I could find no correlation at all between interest rates and property prices. There's occasionally you could see where those two things happened, but not in any statistically significant correlation at all. In fact, I'm going from memory here from our research report, but the correlation was 0.3 or something like that. It was very low, not statistically significant enough to be relevant. You wouldn't. Now that and by the way, we can look at it. We can look at what's happened over the last few years. So interest rates have gone up. They went up the fastest amount. They went up 12 times or whatever, the fastest interest rate hike in history or since whenever, and blah blah blah. And property prices kept going up. Prices kept going up.
Interest rates, if they're going up, it's a sign of economy strength. So that would have business confidence. Then people would probably be more inclined to be purchasing property with more confidence. So it's just that counterintuitive. Like when rates get cut, that's actually a sign of economic weakness, right? So the only difference is that retail can now have more money to buy what they really want, which is the house. And most people, tend to spend what they've got when they come to property.
I think it's a really good point. And I think it's entirely valid. My point of view, though, is that the bigger driver is liquidity. is liquidity in the system. Yeah, it's the bigger driver. So if you look at the last couple of years, state and federal deficits have been huge, and so whilst interest rates have gone up, money's kept flooding into the economy, and that's kept driving property price growth. That plus immigration, plus a whole bunch of other stuff, and so there's all of these other factors, right? Including, if we look at consumer confidence, hasn't really changed since April 2020. So there's that, But to your point, Sam, higher interest rates are a sign of a stronger economy. So that does mean that there's some positive tailwind forces that are going to drive kind of some structural investment ideas. Maybe people have got strong or feel confident in their jobs. Maybe they've potentially gotten salary increases. All of that kind of stuff. All of that stuff can be true, and that can definitely drive it. And so between that, plus immigration, plus liquidity, plus a whole bunch of other things, there's half a dozen other reasons why property prices continue to go up, and interest rates didn't really factor into it. Now, interest rates going down does increase the amount of people who can get access to credit. So that does increase the demand in the market. That does increase liquidity. And so that's a proxy for let's pump the market for full of liquidity. So again, it can have a force on driving prices up, but raising interest rates isn't correlated with prices going down.
The thing I've learned is that it's never one thing, and people are up against massive marketing media campaigns to convince you of things that you don't really know enough about, and people are lacking that. I guess I'm going to say the research element. They're just taking the short-term dopamine hits, thinking they're educated, and they're not doing that hard work. I don't know whether society's been pushing down that path longer and longer, but I feel as though there's a much bigger game being played by, looking at the business cycle and different economic cycles. And that was kind of like what you hit on about Rockhampton was really interesting, that I don't think people are actually going into that level of research, because there is the data, right? But then can you, what's your level of, I guess, analysis through those different economic cycles? Like, you look at short-term data like everyone else, right? And then you take that bigger view, but can you sort of help educate the listeners sort of what they're not seeing that you are seeing in this world?
So it's not a fair comparison. That's what I would say. So
not when you've built out a data science team in property versus somebody that's an average Joe.
I'll explain a little bit further, right? Because Sam, what you said is really, 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 really important. So real estate is the largest asset class in the world by a long shot, and it is the least understood. So it's an $11 trillion asset class in Australia, and 99.99999999999% of people have no fucking idea how it works. Excuse the language. They don't know. They kind of guess a little bit and stuff like that. And by the way, I'm not suggesting that we have some oracle of truth and we know absolutely everything, right? But what we decided to do was go on a deep quest to and we're still on that quest, by the way, to try and get as close to truth as you can find, because it is such a And this is actually really the driver. It's the intellectual pursuit of trying to solve something that's incredibly complex. I find that stock markets and stuff are a lot less complex. Like there's you got the individual business factors, and you got some external drivers, and it's basically like liquidity times the business fundamentals equals returns in some fashion, right? It's but with real estate, it's there's so much more to it. Not least of which because it's not just a supply and demand market. It's a supply and demand market, but it's also a matching market, which means that people make decisions in these markets based on more than just supply and demand factors, right? It's not just a commodity. And there's also not a CEO of real estate who can have a plane crash over the Pacific or something like that, right? So you have these kind of interesting factors that layer into it. Now, in order to answer, so there's a really great book called The Man Who Solved the Market. It's about Jim Simons, who built one of literally the most successful hedge fund in the history of the planet. And we'd already started on our kind of quest to solve this stuff, but I read his book and I was like, man, it's awesome. They built this hedge fund that was like making trading decisions based on the price of corn in Kazakhstan, and stuff like really random stuff that they could draw these. It's insane, right? And so the sort of answer is how much data can you get, and what is your ability to weave through that data? And this comes back to the information advantage. Now, for us personally, because there is so much that has to go into it. Now, you can cook it down to a few simple things. By the way, I'll come back to what I was going to say in a second. You can cook it down to a couple of simple things, right? So there's like some core metrics. I'm not going to give away what they are necessarily on here because the sort of proprietary metrics that we use internally. There's a couple of core metrics that you can use to kind of get you 80% of the way, right? And go, okay, cool, yep, that looks good. But to get the difference between 80% and let's say 95%, that's a really big delta where it's very hard to do. So we have analyzed several billion data points now. I'm not sure where we're up to. It might be up to 4 billion data points. We consume an insane amount of data every single month. We have built proprietary models to be able to transform that data into usable insights. So we had to invent 2 pieces of technology in order to create the models to give us better insights about the market. So we had to develop we developed a mechanism called CAM, which is basically a machine learning or an algorithmic approach to correlation analysis machine, which is basically help us to understand the correlation between incredibly large data sets to try and work out, okay, is there a relationship between the price of beef and a real estate market, right? So for example, just using that as an example. Then we also have to build another piece of technology which we called FAST, feature automated selection technology, which would help us to identify what features to build into our models to better understand the market. That led us to develop things like our real estate market predictive models, so we can forecast real estate markets 15 months into the future. And we've been recognised as we got number 2 in the most innovative companies in Australia last year based on that innovation. So the point that I'm trying to get to there is not to kind of grandstand about like look at our cool stuff. The point is to get to a point where you start to get close, and I'm not saying we're at 100%, to get closer to understanding the quantum of information you need to consume and understand, and the interrelationships between vastly different data sets is incredibly important. Like, what's the relationship between population? What's the I'll give you one. This is a free hit. There's a thing called an ICC score, ICSEA, and that scores schools based on a bunch of factors. So, there's like school quality, socio-demographic of the area, and there's like a whole bunch of factors that make up this ICC score. And every school in Australia has an ICC score, ICSEA. So we just call it ICC. And what we discovered is that not the absolute position, not the absolute score that a school had on the ICC metric would define whether a property market was going to grow, but the change in the score from year to year. So if a school moved in a positive direction, that positive direction would be correlated with a positive movement in the property market price. So it wasn't just about like, the best schools have the best growth. No. If the ICC score was static, that actually probably meant that the growth was going to be pretty static too, or that it would become less correlated. But if it moved quickly, then we could see there was a relationship.
What was the catchment period? So was it like just one year on year, or was it over like a 5-year sort of trend? I can't remember how far back we got the data. They update the scores annually, and we got the full data set history of it, so that we could analyze it. Yeah,
it makes sense with like gentrification into an area for families that want their children to go to better schools, right?
Yeah,
and increase.
Yes, but I mean, so yes, that makes sense. But what's interesting is the second order effect of the information. It's not just we want to move to somewhere where the school is good. So that would indicate like, okay, there's a school that's got a high ICC score. Let's try and move into that area so that we can put our kids in a better school. What's actually interesting is that a school could go from shit to less shit. And that would be an indicator of growth. Now, that would also be an indicator that the socioeconomic demographic profile of the area is changing. So gentrification, to your point, the standard of education of that school is improving, which in turn will feed more people from potentially a slightly lower socioeconomic cohort to want to desire to be that one. And so there's this like, it's nuanced with like lots of second order effects, as opposed to like, I don't know, King's College or whatever it is in Sydney. All right, that's good. So everyone should want to try and move as close to that as possible. So you could be in a low socioeconomic area, but you could have the school improved by, let's say, 50% in that area, and that would have a way bigger impact than just a good school being good.
A good school being good for decades, and everybody knowing about that in that certain area in Sydney, and because the movement is like maybe 2% a year increase, or maybe even just stagnant, but still they've got the prestige of that school.
That comes back to the information advantage thing, right? Because if everyone knows, if it's already a known thing, then the information has already been factored into that market.
Yeah, it's like the counter-cyclical approach is what I like to think. It's the thing. Jaryd and I have been interested in financial markets for a long time, and we've got it wrong for a long time. And the thing that I've come to understand now is, just don't listen to what people are telling you. Like, do the research, but find the data, get educated. Because go to Perth. Probably it's too late now, in my opinion, in most pockets, and then Townsville, you said, that's on everyone's lips, and then goes into even Gladstone now, it's on everyone's lips, but that market is intense. But you can still get, as you said, growth out of it. But what's your strategy? I think people really struggle with that, long term, because they don't understand, right? And then you do all this data and all this research, and you spend millions of dollars every single year, and you have the best people in your team to actually educate people. Do you still get a bit of pushback from clients coming on board with they don't believe in it, or they just don't trust, because we're in this trustless period at the moment?
So interesting you mentioned the trustless period. That's like a by the way, that's just something we've been talking about a lot. Yeah, the market, just I'll come back to your question. The whole kind of trustless thing at the moment is fascinating, right? Because people, society generally, has started to just lose trust in everything. It's it's really interesting to watch, and it's really interesting to kind of think about how and why that is happening. I saw somebody the other day run a webinar. It's how to win in the trustless or the no trust epidemic, or the trustless epidemic. I don't know, something like that.
Well, when you've got so many people that can jump on Instagram and Facebook and YouTube and just talk shit, and then you got the blind leading the blind, and then people get hurt because of it. Of course, there's going to be trust issues, and then when we don't need to go into what's happened in the last few years with governments and stuff, but.
Yeah, but I actually think the government thing is a big part of it too, right?
Oh,
so I think
huge.
I think that people have realized that the things that they once took to be true are no longer reliably true, which then causes them to question everything, right? So mainstream media, people thought news was news. Pretty simple. They thought it was an information source. Turns out it's not, right? So I think I think that's really interesting. Back to your point, Sam. So I want to touch on, I'm going to circle back to strategy, because I think that is so much more important than just picking the right location anyway. As it relates to your question, how do our sort of clients experience that? So I think that there's a degree to which the fact that we've proven it, we've bought, something like 1,700 properties over the last few years. That's a lot, and we've won every time. So, you start to build up a body of evidence that people go, okay, there's something here, and I'm just going to, the evidence can show me that it can be true. It's not to say that people don't have doubts, that's for sure. And so our approach is to recognize that people would have doubts, and to recognize that people need to become informed, because the only way to make a good decision is to make an informed and intelligent decision. And so we don't ever say, trust us, we've got scientists. We try and take people on a journey and say, let me explain to you, let me show you what we can see. Let me explain to you what this means. And in the process, you're going to become a more intelligent investor and a more informed investor. And that's going to allow you to make a good decision. And so that's the approach that we take when we get to that stage.
And that happens through your podcast and the content you put out there. It's the same with my primary business, but by the time somebody comes to work with you, the trust is there. Otherwise,
I think that's one part of it, Jaryd, but I'd also say the other part of it is when the rubber hits the road and someone's looking at a property, right? So it's one thing to decide to work with someone. Okay, that's sort of all the how do you build trust with people, and how do you add value to people before they even become a client? We try and do that. We try and do that a lot. We try and give a lot of value for free. Our real mission is just to try and help as many people as possible to escape the status quo. So For us, that's important. But when the rubber hits the road, right? And if you're buying your very first investment property and someone's saying, hey, we want you to buy we found this awesome property and it's in XYZ location, and the person has got a systemic bias against that location, that's when the rubber hits the road and someone needs to actually put the money down on the table. That's when it really matters. That's when it really matters for them to be able to go, okay, why am I going to believe this? Like, how am I going to sleep well at night? Because the thing is, buying a property is very expensive, right? It doesn't even matter if you're buying a cheap property; it's still very expensive, right? Do you know how much? One share of Tesla is like, I don't know, I think $400 US today, right? So whatever that is in Aussie dollars at the moment. A property is like $400,000, right? So the quantum of difference on a single bet is huge, and so we need to. I think it's very important for everyone to kind of take that into consideration. So we just try and take people on that journey. But the other part of it is, and I want to circle back because I think it's really, really important, is strategy. Because if you don't have a strategy, then no matter how much information you're given, even if it's very high quality information, you can't even know if you're making the right decision. Yeah, so, like, how would you know? Like, if let's say I was to come to you, Jaryd and Sam, and I was to say, "Hey, I found you this property, and I can guarantee you it's going to grow by X amount in a year." How would you even know if that? Can't guarantee anyone's going to get growth, but like, how would you know that that's the right property for you? You wouldn't unless you had a strategy and it fit within it.
Unless you had a strategy, unless you know where you're at in your portfolio and. One, how much is that strategy, right? Is it in the ballpark that I'm willing to? Is it less than where I'm at in my portfolio?
Yeah.
Is it more? Is it possible for me to do? So coming back to strategy, it's what does your first investment look like, and based on where you're at in your own personal life, and then your second, third, fourth, and so on and so forth. So, I have a question around it, but like I'll let you finish. Yeah.
That's great. Sam, did you want to say something?
Yeah, well, strategy for me, like I do a lot of that with clients. It's looking at the bigger picture, like zoom out. Everyone's just, they get their deposit. They know they need to invest. They understand, as I said, debasement is one key thing that people are coming out. But it's like you've got $400,000 to spend. Where do you spend it? It's going, well, how does that fit into your bigger structure? Like, what are your goals? What's your budget? What's your cash flow requirements? Because there's no point in buying a property that if it's costing you $200 a week to hold, you're going to get jack of it and sell it in 2 years when the goal is to have at least a 4-year sort of hold period. That's what I think people struggle with. And then you add on as I said, the media. Like, it's not property. There's shares. There's crypto. There's overload of information that people are just getting pumped with. And let's face it, there's marketing teams thinking, how can we get you on your phone more to create that unknown element.
Yeah, I think it's a really good point, right? So, and you touched on something that I kind of use as an example. It's like, if you don't have a strategy, and let's just, again, hypothetically, let's just say Bondi was the best growth market in Australia, right? If you didn't have a strategy and you said, where am I going to get the most growth? And let's just say you decided that it was Bondi, and then you went and bought a property in Bondi, and it was a couple of $1 million property, and it had, a 1% yield or something like that. If you can't afford to hold it, if you can't afford the negative cash flow, you're toast. You'll never even realize the gains. Now, let's say you can just afford the negative cash flow. That doesn't mean you're going to be able to do anything with it. You may not be able to refinance it. You may not be able to. So you may be stuck. So we actually built technology specifically to solve this, because our kind of like progression of building things started with when we very first started our company. I remember our very first client. Most business owners, when they get their first client, they're like, "Oh my God, yay, it's real! Look, someone." That didn't happen for me. I won't mention his name, but he's still a client today. We bought a lot of properties together. But that first client, when he was scared because he'd personally invested before and made a mistake, and he lost a bunch of money. And he basically said, "Look, this is my only shot. I've got to get this right. And I'm going to trust you with my financial future more than I trust myself." And that was our first client. And like, we're good people. We want to do good work. But I was like, holy shit, what if we fuck this up? Like, what if we do our best work with the highest integrity and absolutely put our client's best interest at first? What if we accidentally get it wrong? What if? mean, that's someone's financial future. That's their hopes, dreams. Literally, their life depends on it. The living of their life, the future that they desire depends on that. And I was like, man, this is intense. So I didn't have that. Like, I was gripped by an overwhelming sense of responsibility. I was like, okay, I get this now. People are trusting me more than they trust themselves to create the life they want. Okay? Big shoes to fill. Got it. So the very first technology we started to develop was trying to work out, okay, well, how do we make sure that we're buying in the right property, right place, right time? Like, how do we identify locations? How do we identify the right properties in those locations? Like, how do we get the property selection and market timing piece correct? Like, how do we get that right? That was the first thing. So then we nailed that. We built a whole bunch of tech around that, and we nailed it. Like, we smoked it. We're like, yeah, like, we can do this. But then the question is, well, how do we know that property in that location is going to be right for that individual? Everyone's situation is different. Everyone's goals are different. Everyone's personal financial situation, everything, risk profiles, they're all different. So the right property for me might not be the right property for you. Even if you've got, like, let's say 10 great locations to buy in, they're not all equal. How do you think about concentration risk? How do you think about correlation? How do you think about all these things? So we're like, So it's not just about finding the latest hotspot. Okay, how would we know which of, like, the latest hotspots, to kind of use that kind of cheap terminology, would be the right one for a specific individual? Well, we'd have to work out what is their portfolio strategy. And so then we said, okay, well, how do we need to think about portfolio construction such that we can make sure our clients are making the best decisions around asset selection? And so it really comes down to, and I'm sure you guys already know this because you guys help people and coach people and stuff all the time, right? So, but it really comes down to three key factors. There's three constraints: cash flow, access to cash flow, access to debt, access to capital. And optimizing for those three constraints is really how you can build a property portfolio that allows you to go from 1 to 5 and beyond. And most people, 99% of property investors never get to 5 properties. And I haven't seen anyone achieve financial freedom in real estate with less than 5 properties, which means that 99% of property investors never even get to. That's like the dirty secret of the real estate investing sector, is that nobody actually tells you that most people never buy enough properties to become financially free through real estate. Some people even say it's not possible, right? But they say it's not possible because people don't do it. And it's like, well, and you actually can do it. Now, I know just before we jumped on air, you guys were talking about commercial. Commercial is a great way to augment cash flows and stuff like that. So we don't do that. But, we built technology to help us really refine that approach. And then based on the portfolio strategy, i.e., how do you get from A to B to C to D? And how do you think about those steps before you even start this first step? How do you do that effectively? Because otherwise, how would you know? You might buy a property that doesn't allow you to get to property number 2, or that it's going to allow you to get to property number 2, but you're going to have to wait 4 years. If you'd made a different decision, maybe you could get to property number 2 in 6 months or 12 months if you just made a slightly different decision. So strategy always comes first. So we have what we call our growth system, portfolio growth system, and it's very simplistically, and there's obviously a lot that goes into this because we've built tech around all of it. Starts with planning. Planning is the first step. So we build a plan in the first instance. Finance, of course, real estate's a game of finance with a few houses in the middle. So build the plan, make sure you can finance it, make sure you've got a finance strategy that's going to align with the plan, because otherwise, like, again, how are you going to get you're going to get stuck, right? So start by building a plan. So plan, finance, then we acquire the right property, and then we optimize, because every plan is going to change. You might say, all right, so the plan looks something like, and again, I'm oversimplifying it here. The plan looks something like buy a $500,000 property this year and buy with a 5.5% yield, and then buy a $500,000 property next year with a 5.5% yield, and whatever, right? It wouldn't be that simplistic. Let's just use that as an example. If in fact you buy a $475,000 property with a 6% yield, then instantly the plan is different, right? So recalibrating the plan, then continuing to update and optimize the plan based on actual and reality, and optimizing the portfolio is actually then how. So the strategy has to be alive. The strategy has to be living. So when you start, you go, okay, this is our best work on what we think we're going to be able to do. This is our best work. Okay, good. We all feel like this is good. Great. Yep, we're happy with that. Cool. Then as soon as you take action, right, now we need to do another plan. And so it's this constant process, and it's a cycle, plan, finance, acquire, optimize, plan, finance. It just keeps round and round and round and round and round. But if you do that effectively, then you're going to achieve your goals in like stupidly short periods of time.
Yeah, the way I like to think about it is like, when everybody knows, start with the end in mind, and say you've got a destination that you want to get to and you're using Google Maps. Very simple terms is like, say you've got multiple stops on the way that is going to get you there. Say there's 3, and you get to the first one. You plug in your end destination and add your stops in Google Maps, and then you get to the first stop, and then you reassess. All right, where am I at? Is there, based on the current conditions now, is there less traffic on a different route that can get me to my goals faster, basically?
Yeah.
And then do that for the next one and the next one and the next one.
Or maybe before. Yeah, maybe in between 2 stops, you decide, actually, I want to take a detour and go get a coffee. So I'm going to go down here and go get a coffee, right? Because detours happen in life as well. Like, you build a plan, you build a 10-year plan, but then, like, what happens if you get long service leave and want to go travel a little bit? And how's that going to change your plan?
And the end destination that you start with will fluctuate and move as well. Because you'll be like, I've been on this journey for X amount of time. Maybe we want to change it a little bit too.
Yeah. You know what's interesting about that is I actually see people's goals. So most people, because they're not very good at goal setting, they set these really big targets, right? Then as they go, they realize that they unlock freedom way before they hit any of those targets. That's the interesting thing. It's like, say, it might be $100,000 cash flow from a property portfolio or $200,000 cash flow from a property portfolio, which is totally achievable. But what tends to happen is people get to property 2 or 3 and they're like, oh my God, I already feel like I'm free. So it's like, it's this, the transformation happens way before you get to the destination.
I think it's more about, for people, you're right. And I think they also don't realize that what their actual goal is. Maybe they don't realize that, like, what they want is freedom.
Yeah.
Or until they start to get to it and they're like, oh, I don't need that much money. Like, I don't need 500K a year or $1 million a year in positive cash flow if my goal is just ridiculously big. But when they get to that, they're like, oh, okay, this is like this is what I actually value. Because maybe if they try to get to the goal that they initially started with, it's just adding more stress to their life, and they're like, well, what's the point? Like, I've got what I would need now.
The only constant is change in this world. And then, like, even myself, along with Jaryd, no doubt Goose as well, like, you evolve as a human and you prioritize different things, especially later in life. Like, it's not like, my message to the world is, it's not about money. It's never about any one thing. It's like health, relationships, and wealth can get you to that level of contentment in life. And I guess I'm also mindful of everyone's time as well. But it's just the hardest thing that I've found in this world, and especially in property, is finding the right people to work with. And, like, maybe that is, I'm one of those trustless people that is in this society. And
no, I don't think so, man. I think it's really tricky, right? So even when we first started, so to your point, the only constant is change, right? But when we first started Dashdot back in 2019, the whole industry was very different, right? So the concept of borderless investing was bizarre. Like, we as a company, so we kind of started as a buyer's agency. We've evolved way beyond that. So we don't even call ourselves a buyer's agency anymore because our scope of what we offer has broadened so massively. But, even at that time, people didn't know what a buyer's agent was. People literally didn't know that you can invest interstate, right, from where you live. Like, it was crazy. But even then, the real estate sector had a grimy reputation. I didn't wake up one day and say, oh, I want to be a real estate guy. Like God, no. Like, no one wanted, like, who would want to be a real estate guy? Like, they were, as far as I was concerned, they were all like cheap snake oil salesmen, like, and grimy and, and crooks and spruikers and stuff like that. And personally, Gabby and I had fallen subject to some kind of unscrupulous characters in our journey of property as well. And so, like, we'd seen it. And so, like, we knew from the get-go that you've really got to fight pretty hard to make sure you don't slip into sort of that territory. Because, I mean, as I said earlier, like, you could do your best work and accidentally come across as disingenuous or something like that. You're never going to please everyone. But I also think that, the property sector has expanded a lot over the last few years. There's a lot more property investment companies. There's a lot of buyers agents out there, all of that kind of stuff. And so the marketplace of choices for consumers is a lot bigger, and that breeds confusion. Because if your only choice is to choose between one of 5 operators in a market, then you've got only going to choose between one of 5. But if it's between one of 500, and if everyone's ostensibly saying the same thing, whether it is true or not, that actually makes it a lot harder for consumers. And that's the one thing that I've noticed over the last couple of years. And look, I'm fine with market evolution, and I'm fine with everyone who wants to build a business in the real estate sector. I think it's great. I think awesome. The issue though is that you have a lot of people, and I think Jaryd, maybe you mentioned it earlier, like the blind leading the blind. You have a lot of people out there who don't actually know. They're good people with good intentions, but don't actually know what they're doing. Who want to know what they're doing, but don't know what they're doing, and that actually can be challenging for consumers to try and weed through that. So, yeah, it's tricky.
Yeah, and you don't know until you get into the weeds, especially the buyer's agent industry. There's people good at marketing, but then there's the fulfillment. What are you paying for? And even to a point, any investing, right? Like you're investing with that long-term mindset, so you need time to prove that. The proof's in the pudding, right? And I guess the beautiful thing about Dashdot, right, is you've got you're coming on 7 years of experience of constant portfolio growth, and it's a beautiful thing to change people's lives, mate. So
and it takes time. Like we were coming up to 6 years, So like we were that company 6 years ago that we were just starting out too, right? And so, but time helps. But we're really proud of the impact we're having. That's the main driver for us. Like you won't see me driving around in a Lamborghini or buying fancy suits or whatever. We just, our whole modus operandi from the get-go is just how do we help people. And so over the last 5 years, we've grown a lot. And we've just heaved all of our profits back into creating better solutions for consumers. Like that's how and why we've been able to build all of our tech. That's how and why we've been able to do what we've been able to do, because we're just trying to create better results for people. Because the way that I think about it is, the world is going to continue is changing faster and faster and faster. And we've kind of touched on things like monetary debasement and a few other things, but I don't see investing as a luxury. I think it's a necessity. I think it's essential if you don't want to, like, if you want to have any preservation of your standard of living, if you want to have any, like, not even some kind of luxury. It's not like invest and get rich and go buy a private jet. Like get real. Like if you just want to be okay, basically, in the future, then you've got a real prerogative to invest, because your money is going to be worth less and less over time. There's lots of technological changes that are coming along in society. And so you have a choice. Like you have a choice to work out how do you preserve your economic energy so that you can transport it through time and space and do it in an effective fashion so you can live your best life and live a good life for your family, or not. And if you don't, like, society is getting bifurcated into two classes, asset holders and non-asset holders. And that's really, people talk about the class divide. It's not rich versus poor. It's asset owners and non-asset owners.
Divide.
And it's like, I really think that what a lot of people are missing is they think investing is a number go up strategy. Like, I want to go make money. What they actually really need to start thinking about it as is like a life-saving strategy. How do I make sure I don't drown? Like, because there's a lifeboat and it's getting further and further away. And if you don't get on the lifeboat, you might not get on. And so, and that's our drive. I mean, we could have kind of like cashed out and sailed off into the sunset a while ago. But our drive is like, well, how do we make sure that we don't leave people behind? How do we make sure that everyone has the opportunity to build a life of freedom, choice, and abundance?
I love it.
So,
congrats, Goose, on not just what you've built, but the people that you've helped and the lives that you've changed. It is amazing.
Thanks,
definitely
man.
got me started in what one of our good mates, Charlie, started in property and frothing it, and will continue for a long period of time. Everybody that's listening, thank you for listening. I'll put a link to Dashdot to work with Dashdot. You can get a good deal with that link. Check it out. That'll be in the show notes. Goose, is there anywhere else that we can send people to check out more about what you guys are up to, or just?
So you can check out our YouTube channel. It's currently called, when's this episode going to come out, actually?
Early Jan or late Jan.
Okay. Yeah. So search for the Investor Lab on YouTube. We'll be doing a lot more content there. So that'll be a great place to interact and engage. We're going to be doing a lot of live podcasts, so people are going to be able to interact with us in a real live format every single week. We're excited to do that, to be able to connect with people more directly. So that'd be the best way to go.
Awesome. Thanks so much, Goose, for your time, and thanks
Appreciate
everybody for listening.
Yeah, mate. Thanks for everything you're doing and changing the world. What a good thing to leave behind, when we all transcend into the next realm, wherever that may be.
Thanks, mate.
Appreciate it.